Hey guys, um, if I've recorded some of these things before and I'm repeating, I do apologize. I don't remember what I've done and what I haven't done sometimes, and um, but anyway, Bruce Greenwald wrote two books, and I read the first one. I bought the second one, but I really don't know where the hell I put it at. Sometimes, you have something very valuable and you put it someplace that's so safe that you can't recall where it is. But I'll probably have to go to Barnes and Noble and buy another one because I really uh, would like to read the second one. I know I got it somewhere. I just don't know where I put it at. But this is actually from the Columbia Business School, as you know. Bruce Greenwald. I think he's retired now. I think he maybe he is a analyst or something at or an advisor. I think he's maybe an advisor at Himalayan Capital. We can go look. Let's go to Guru Focus. Let's go to Gurus. Let me see. Let's see if Bruce is up here. I forgot what it's called. Himalayan Capital or something was the. Let me see. Why the hell they got Al Gore up here? I mean, what a if you want to see what Al Gore's portfolio is, um, I don't recommend Kathy Wood's portfolio. So, since we're here and I talked about it in my last video, let's just peek at. Uh, Maybe I gotta be a member. I don't know. But I don't know. Maybe he changed it because I remember before he had a third in Berkshire Hathaway, he had a third in Lei Lu, and he had a third in Wells Fargo, Bank of America, and Costco. So, I mean, according to this, I don't even see Costco anywhere. But he's got a bunch in Alibaba, looks like. But this doesn't include, I guess, what he has in Berkshire and what he has in Lei Lu. But still has Wells Fargo and Bank of America. But I mean, anyone can go look up here and see what the top guys, have and copycat what they got if they want. Here's Lei Lu right here. But I think Bruce Greenwald is and maybe it won't let me look at it. Maybe I got to be a member or something. But Bruce Greenwald, I think, is on this board, who is a consultant for Himalayan Capital, I believe. But looks like he jumped on the Buffett bandwagon, and Bank of America, Berkshire Hathaway, Google, and Apple. Micron, sold out of Micron. I don't know what the hell this is. Bancorp. A lot of the banks were, 50 to 70% off. So if they're not going out of business, it's possible to have made a large amount of money. And as you can see, he's upped his shares 20%. But as you can see, they if you can beat the market, this is it right here, guys. Here's the S&P right here, and here's his portfolio. His portfolio. He's not beating the market by much. I mean, he's 5 or 6 percentage points, but if you can beat the market by 5 or 6 percentage points, compounded over 30 years, 20 years, that makes a big difference. And if you were looking at a pizza pie, this is I hate this damn thing. It almost might be worth it just to buy a damn membership to stop the damn pop-up from popping up. But he's got 28% in Bank of America, 20% in Google, 17% in Berkshire. Well, this is Google too. So that Google has 2 different symbols. So I guess he's 36% in the Google, and like I said, I really like Google as well. The whole thing I'm doing on YouTube is owned by Google. But 8% in Apple, and then the Bancorp one. Dumps Micron, adds East West Bancorp. But as you can see, this is, a value investor, but he's in all these companies are big companies, except for this one. Almost the biggest. Berkshire Hathaway is the 11th largest market cap company in America, as far as I know, something like that. Top 15. Well, here's a Leilu's profile. Born and raised in China, attended Columbia University, received 3 degrees. Farm embraced the value investing principles of Benjamin Graham, Warren Buffett, and Charlie Munger. Primarily focused on publicly traded companies in Asia with an emphasis in China. Well, yeah, I don't see any Asian companies. But I like it how they got the pie here, so you can see, a person's portfolio and how you can. The ones I like to look at, if I'm looking, is the ones that are concentrated. The ones that have, like look at this guy. He's got six 6 stocks. And he's got a big chunk in the Berkshire as well. Walgreens, Citigroup, Intel. I don't know what the hell that is. I don't know what that is. I don't know what that is. I don't know what that is. And I don't know what those two are either. But obviously he likes this one. Look, that's 55% of his portfolio is in this one company. So he obviously believes, for whatever reason, that this one right here is a really good pick. It's got a high dividend. Oh yeah, I am familiar with this one a little bit. I think I bought it in the past before. It's funny, here I have a lot of steel companies in my portfolio, and this guy has a steel company right here. But as you can see, he's got 50% in this one company. He's got 23% in this one. 12.83 in Berkshire. And I have no idea who the hell this guy is. Now, I've heard of Bruce Berkowitz. I think this thing right here, I think this is like a kind of like a value one, and you can see they got a lot of picks, 487 stocks. So they're taking they got a lot of little bets going around. And there's 5 pages. So they got a lot of banks there. Look at all these banks. I don't like banks right now. And as you can see, this is the comparison to the S&P. So they've managed to stay a couple points above the S&P as well, but not by much. You can see in 2013 they had a 40% return, 13%, -7, 20%, 20%, almost 20%, -14%, almost 30%. So they got a really good track record, and you can see the diversity they have. So they have a lot of small bets over a lot of different industries. And here's their little breakdown. But yeah, if you ever need, and I've looked at this sometimes when if I'm out of ideas or something, I'll look and see, like maybe, like that one where this guy's got 50% of his portfolio in, that interests me, and then sometimes you will find, this guy got 600 stock, Jeremy Grantham. He's one of the guys that talks about the bubble, and here's Jim Simmons with, look how many stocks he's got. I mean, this is one of the greatest investors of all time right here. But he's made a lot of money in different, by investing all over the world in places that people normally don't invest. You can see his portfolio. Unfortunately, I can't see some stuff because I'm not a member. I wish you could see his performance because I know he's done really well. Here's the top holdings you can see. So like nothing in his portfolio is really above like 1 or 2%. Seth Carlman, this is a really good value investor right here. I guess all these guys are value investors, or most of them, but so he's kind of underperformed a little bit, but from these 5 years right here, it was compounding at 13%. I don't see the recent stuff, but this is his portfolio, and you'll see a lot more odd picks from this guy, and he does some. He'll invest in debt or other things. So, but a lot of these companies that he has, I've never heard. I mean, of course, Discovery, Warner Brothers. I liked this one back when the pandemic happened. He's got Google as well. Here's, one of the. I think this was Ben Graham's thing. This Tweety Brown. I can't remember, but Tweety and Brown. What was in some of the stuff I've been reading. As you can see, they got some foreign companies like Nestle, which is the chocolate. I don't know. This is Roche. I thought it was Royce for a minute. But this is their portfolio. They don't have very, small bets. So there's a lot of different strategies. I mean, you can pick 5 stocks and have 50% in one, or 20% in all of them, or you can have hundreds and 100 and put a 1 percentage point in each one or whatever. But this one says Tweety Brown as well. Something like this only has like 9 stocks. This is somewhat, interesting to see. They have a lot more fluctuations here because they got less, less companies. So if you're right, it's going to go up a lot more. This is a lot of tech stuff like Salesforce, Spotify, New York Times. Got some real estate in there. So this is kind of his portfolio breakdown. Where 20, so he must really like this one and this one, these two. These two were basically close to 50%. But yeah, I was trying to see if Bruce was up here, but he's not because I guess here's Bill Ackman. He's okay. What I don't like about him, I guess, is when the pandemic hit, he got on the air and started crying and telling us the sky was falling, and he's telling you to do one thing at the same time he's selling, so you can't always believe everything he says. But he put on a marvelous performance. Maybe they need to give him an Oscar for his crying routine. But so he really likes Chipotle. He likes Restaurant Brands International. Like I think that's not a good idea because what happens when people don't have money? What's the first thing they cut? They cut going out to eat, right? So if people aren't going out to eat, these businesses may not exist. We got Lowe's. I mean, Lowe's was good during the pandemic because everyone was home. They got to sit around all day when they decided to build up the value of their home. They're looking at their sink that maybe has got a leak in it, and they can't work. The government shut all the businesses down, so they're sitting at home twiddling their fingers. And they're like, hey, the wife goes, hey, let's go to Lowe's and let's fix up the sink and let's fix this leak and we need to cut that tree down in the backyard and redo the fence and blah, blah, blah. But people don't have the money now to be going to Lowe's and stuff. Here's another person who likes Google. So we've seen a trend just by looking at a couple of these gurus is there's a lot of them that really like. I'm just curious. Let me just peek at this Al Gore's thing real quick. You know, he's the tree hugger. I don't see any tree hugger stocks. You know, Al Gore pollutes more in one one private jet trip from, you know, D.C. to New York than the average person does an entire year. But yet he's telling us how bad we are stuff. Yeah, it really bothers me that they even have Kathy Wood up here. She's not a value investor. she's she's a horrible person in general. Yeah, Joel Greenblatt. He's another value investor. We can see a lot of these guys. They got these big cap companies. You know, Microsoft, Apple, Facebook, Johnson and Johnson, Amazon. So, you know, me, I like the smaller cap companies, but most of these, you know, are big mega caps. But and here's a screener right here. You can have another stock screener. But I forgot what I was going to say. But anyway, what the purpose of this was to listen to this interview, and hopefully you guys can take something out of it.
A conversation with Bruce Greenwald on the occasion of the publication of the second edition of his value investing textbook, Value Investing from Graham to Buffett and Beyond. The second edition finally came out after a long wait. It's always an intense experience and one that is not for the faint of heart. So I'm looking forward to yet another conversation with Bruce. So welcome, Bruce.
Thank you for the kind introduction. But I ought to warn people that, as usual, my idea of a good conversation is I talk and everybody else listens.
Yes. So this is why a Zoom conversation is ideal. So the way we're going to do this is
and sorry I'm fast forwarding, guys, but I really don't care what this guy say. I want to hear what Bruce has to say.
Yeah, well, how come he's coming now?
Okay, so what you have to understand about Judd and I in these books is that we have a phenomenal ability to release them at exactly the wrong time. So that the first edition of this book came out in 1999 at absolutely the peak of the telecom bubble, when everybody said value investing was dead. And I'm pleased to note that this book was done again in a period of the FANGs where, again, now in 2020, 2019, everybody again feels that value investing is dead. So we have not lost our gift for bringing out books at the wrong time. But let me say this. I think that at least this time, we have addressed, probably partially inadvertently, what I think are, at this time, the really big issues with value investing.
So, very good. So let's talk about this, and let's talk about, talk a little bit about that. Can you talk about this?
I think it's important to start really with an understanding of what value investing has always been, as conceived by Graham Dodd and, of course, Buffett and the other really distinguished value investors. And I think it's really consists of two basic ideas. The first is you look for opportunities where nobody else is looking, and you stay away from the crowds that are overpaying for glamorous opportunities. So there is that idea of just statistically cheap, ugly, out of fashion, and I don't think in an important sense that has gone away. Now, if you look at the statistical value models, simple statistical metrics of what is poor, out of fashion, overlooked are no longer as reliable as they were, and we'll talk about the reasons why I think that's the case. I think the second thing about value investing, and it's really where the value comes in, is that the Graham and Dodd tradition is a tradition of approaching valuations with a clarity and a precision that normal investors don't. It's more than just slapping a multiple on things and saying, okay, this is a growing business, it's worth 40 times earnings. It's more than just forecasting next quarter's earnings and trying to guess where the price is going. It's really about understanding what it is that you're buying. And there, I think that the really big change in this edition is that traditionally what Ben Graham and David Dodd bought were assets. And they bought competitive businesses or assets in competitive businesses. And for those, growth doesn't matter, because the force of competition means that...
What did he say? Growth doesn't matter in a competitive business. You got all these damn idiots that talk about growth. Growth has zero value in a competitive environment. Sometimes it's a negative value.
That if you invest in growth, you're going to earn the cost of capital. If you get organic growth, that's just going to attract more competition, and you're, again, unless you invest money, not going to earn more, and you're just going to earn a fair return. So I think that in their day, they focused on the part of the market where, and I think this is always important to understand, where their asset value, earnings power value approach was much better and a much clearer framework for incorporating externally obtained information than these stupid DCF models that superseded them. The problem is that they never dealt.
And a DCF model is discounted cash flow.
And I think that's where, because of fundamental underlying changes in the economy, value investing has got to adapt. Now, I don't think that means getting away from value, because really it's all about understanding how much growth is worth and when it's worth anything at all. So there is a value approach to growth. And I think in a sense, it's the growth investors who have to adapt. So I think value is clearly going to have to go in that direction. The second edition is really all about how to go in that direction, but at the same time to be true to those Graham and Dodd principles of knowing what you're buying and having a really good valuation framework when you address the issue of growth.
Yeah. So in that sense, I think there's real value in those chapters 6, 7, and 8, and in particular, what does this look like?
Okay, so let me just say one thing first and absolutely clear. If you are not in a franchise business, which is a business protected from competition by barriers to entry, which typically are the same thing as incumbent competitive advantages, growth has no value because any value that's there is going to get competed away. So when you talk about value-oriented growth investing,
I'm just going to rewind that because you got all these morons. Growth. That's all they talk about. But it has no value. Nothing.
Protected from competition by barriers to entry, which typically are the same thing as incumbent competitive advantages. Growth has no value because any value that's there is going to get competed away. So when you talk about value-oriented growth investing, you are talking about franchise investing. So if as a value investor you're going to do this in the Graham and Dodd tradition, what you've got to first verify is that this company you're going to buy into has a sustainable franchise, sustainable moats in Buffett's language, sustainable barriers to entry. It turns out that you can actually measure a moat, and I'm sure Warren Buffett always knew this, but would never tell anybody about it, and it's the key to what a franchise looks like, and it's got two elements. So the first element is, if you've got an entrant coming in, what is the minimum viable market share that entrant has to get to? And that's all about economies of scale. So it's how big do they have to be to have sufficient scale economies to be viable? If you look at things like distributing carbonated, caffeinated beverages, you pretty much have to get to 25% local market share to be able to sustain the distribution infrastructure you need, the marketing infrastructure, and the local advertising infrastructure. If you're part of a global automobile market, you can be viable at 1 to 2% market share, and you're not going to keep anybody out at that point. For things like cell phones, you look at cell phone companies, they start to be economically viable at basically 10 to 17% market share. So you start there. You're looking for a situation where the economies of scale make it hard for somebody to enter. And the second element to this equation is, how hard is it and how long does it take for an entrant or a competitor to acquire that market share? And that really is all about share stability, which is driven by customer captivity and whatever proprietary technologies you can bring to the table to help keep competitors out. And there, the measure is simple. So if you look at carbonated soft drinks, caffeinated soft drinks, about 1/10 to 2/10% market share changes hands in any given year. If you're going to get to 25% market share at 1% a year, what you're talking about is a 250-year moat. If you're going to do it at 2% a year, you're talking about a 125-year moat. And that's a powerful moat. So the two elements you're going to look at there are the economies of scale and the proprietary technology and customer captivity that protects those economies of scale. For cell phone companies, you get 15%. Typically there, as much as 0.5% changes hands a year. So you're talking about a 30-year moat. For automobiles, you got to get to 1 to 2%, and 1% changes hands a year. So you're talking about a 1-year moat, which is no moat at all. So what you're looking for are moats, minimum required scale for entrance, and
if you don't know what a moat is, if you look at a medieval castle and you have, imagine your business is the castle and you're trying to protect your business from other companies raiding your castle, and you build a moat. And you put some crocodiles in the moat. A moat's like, it's a maybe it's some water around it surrounding the castle. You got crocodiles in it. Maybe you got some snakes. Maybe you got a drawbridge, and maybe a couple guards, a couple archers all around the castle, and you got some footmen guarding the entrance to the castle. But that's what we're talking about, a moat.
The difficulty of acquiring that scale. That is economies of scale and customer captivity and proprietary technology. Ultimately, of course, to have the economies of scale you need, you want to be the dominant competitor in your market. So all the first and simplest test here is, are you the dominant competitor or the dominant firm in your market? So you start there, and then you look at the required economies of scale, whether they're network effects or whether they're simple fixed costs being spread out, and you look at the customer captivity, the customer behavior in the face of competition. Those are the elements you have to look at.
Can I ask you a question about this, about the issue of customer captivity? So I think it's a brilliant insight in competition demystifying, in fact.
I think that one of the wonderful things that Ben Graham pioneered was looking at history. So the first thing you want to look at is the history of share stability. If you take a 10-year period and you look at the average absolute share change that firms have experienced, so you look at shares at the beginning of the period, you look at shares at the end of the period, you see how much share on average changed hands for the average firm, plus or minus, and you divide it by 10, that's going to give you share stability. And if you don't see that, you don't have to worry about them again.
Exactly.
So you start with the history, and then you start to think about what is it that's going to keep your customers with you and away from anybody else. And the simplest one for high frequency purchases is habit. That it's not worth doing an extensive search to find an alternative to Coca-Cola. And people just naturally, for certain goods, prefer uniformity of experience over variety. So if people talk about variety, that's probably not going to be powerful customer captivity. Then there are search costs. If it's a complicated product and it's a high value product, finding an alternative is not going to be cheap. And that's going to keep customers with you. They're only going to change slowly over time. And finally, there are direct switching costs. So you've got all those elements you're looking for in detail. But as I say, in the Graham and Dodd spirit, you always want to start with this.
So, very good. So can we start talking a little bit about the analytical? So
I think the first, again, you want to start with a good qualitative understanding of what's involved in whenever growth creates value. And, in franchise businesses, there are three aspects of growth that create value that just don't do anything for you in competitive markets. The first, obviously, is organic growth. That's not a surprise. And you want to look at that and what the value of that is. The second is earning above cost of capital research, capital costs on reinvested earnings. It's sort of the value creation from reinvestment, which almost or usually means growth. And the third, what people don't normally think about as growth, is growth in margins that comes from steadily improving technology. Because if you're a competitive firm and the technology improves, all your competitors have it, and it just gets bid out in the price. Whereas if you benefit from barriers to entry, your costs go down, and you get to take home a substantial fraction. So you start there. Then again, the crucial thing about value investors, and it really is going to be what distinguishes value-oriented growth investors from ordinary growth investors, is you have to know how much to pay. And that means knowing what the growing operation is worth. And here is the crucial point of the book. You cannot do that in value terms. That when you've got a growth business, the value is so far out in the future and is so sensitive to changes in the growth rate and the cost of capital that it's really very hard or impossible to put an accurate number on what these firms are worth. But what you can do is answer the question, if I buy this firm at today's price, what kind of a return am I apt to earn? And it is that approach that I think is essential for value investors looking at growth. And you start with just sustainable earnings divided by the price you're paying, which is an earnings return. And again, you do that in a standard earnings power Graham and Dodd framework. But then you have to worry about how much do you get today in cash and how much is going to be reinvested and the value of which is going to be deferred in the future. So the next thing you have to look at and you have to incorporate in this calculated return is how does the management of that company divide those profits? What fraction do you get and what fraction gets reinvested? So say you're earning a 10% earnings return, it's trading at 10 times sustainable earnings. If they're distributing half of it, you've got a 5% cash return, you've got a 5% of your money being reinvested. The quality of management capital allocation determines what you're going to get for that 5% reinvestment. Basically, what you've got to look at the history of is how much value in acquisitions, in cost reduction projects, and so on, has this management generated historically for every dollar they've reinvested. You can think of that as a value creation value. Do they make stupid acquisitions? And there are cases of this in the book where they basically get 20 cents in value for every dollar they invest. And this is actually a pretty good firm except for capital allocation. In which case that 5% reinvestment is worth 1%. If they create $2 of value because they're doing good acquisitions or they're expanding where their competitive advantages apply or they're focused on cost reduction, you could get as much as $2 for every dollar reinvested. In that case, the 5% reinvested is worth 10%. So the second thing you have to calculate is this value creation factor, which is the quality of capital allocation. So you take the retained earnings percentage and multiply it by that value creation value. Then you've got organic growth. And it's organic growth both in sales and in margins that we've talked about from cost reduction. And you're going to look at the history of that because you've got a lot of history. Trying to forecast dramatic changes in the future is almost impossible to do, and Graham and Dodd never tried to do it. It's all about sort of looking at history and betting on continuity. So look at historical growth rates. Now, if those historical growth rates are 12%, they're not going to happen in the future. I mean, the best you're going to do in the long run, because franchise investments or long run investments are 3 to 4% above GDP growth. And then maybe a little bit in margin growth. So the organic growth might be 7%. What you can do then, and again, this is an important Graham and Dodd principle, you have the cash return, the reinvestment return, and the organic growth return. Reinvestment return should translate into a growth rate. And you can look at sort of whether the overall growth in earnings has been close to or equal to the sum of the reinvestment return and the organic growth rate. Once you have that number, you'll know what you're looking at. This is going to be an 8, 6, 10, 12, with for luck, sometimes a 15% return. You know what you're buying. Ultimately, you're going to compare that to what alternative investments pay. And if the market, like it is today, is earning somewhere around 6%, then that's a margin of safety in returns that's really pretty good. Now, there is only one thing that you have to be really careful about. You will notice that what we're talking about here is really a detailed, careful, expanded dividend discount model, which is just the cash return dividends divided by the price plus the growth. That model is wrong. Growth rates and growth returns are not the same thing. A growth rate applies typically when you calculate it based on the history we've talked about to intrinsic value. So if the intrinsic value is $2 billion and that organic growth rate is 3%, you're going to be getting 3% of $2 billion, which is $60 million. Doesn't matter what the market price is, that $60 million is going to get divided by the market price. The market price is $4 billion. It's not a 3% return, it's 1.5% return. So that growth rate has to be multiplied by the ratio of the intrinsic value to the market value to get a growth return. The problem, of course, is you can't calculate the intrinsic value. But here is the thing. company is fairly valued, you're paying a fair price, the intrinsic value and the market value are the same. So an estimate making that assumption is going to be an accurate estimate of returns. So if there's no margin of safety in returns, you calculate the return and it's 6 or 7%. That's what you're going to earn for that growth rate. On the other hand, if you are careful, so that you've got a 12% return against the 7 or 8% cost of capital, that means that intrinsic value is above the market price. And that means that actually this is a better bargain than it is. But here's the thing to be careful of. If you think you're getting a 6% or 5% or 4% return and you're just optimistic about the future, or you pay a very high price, so the cash return is very good. So if you are getting a return that's below the cost of capital, that means the market value is above the intrinsic value, and the value of that growth may be as little as a half to a third of the growth. So in this kind of careful Graham and Dodd based growth investing, the critical thing is, and I think of this as the third element of value investing, you have to be really disciplined. You cannot be optimistic about growth rates, because you're going to be fooling yourself, because you're leaving off necessarily this ratio of intrinsic value to market value from the growth term, and that can kill you if you're too optimistic. So your benchmark return ought to be significantly below the cost of capital. And then there is one other crucial thing that you have to, if you're going to invest intelligently in growth, worry about. Franchises don't last forever. If you think a franchise is likely to last, so it's got a half-life of 50 years, Rule of 72 says that is on average, because you don't know when it's going to die, but the average arrival rate of the death event for that franchise is about 1.4% a year, which is 72 divided by 50. If you think that's a 30-year franchise, that fade rate or that death rate is 72 divided by 30, which is 2.4%, and you gotta have a margin of safety to cover that fade rate. So you cannot ignore the fact that these franchises go away. If you're gonna invest in railroads, you're gonna invest in old technology metallurgical companies, you better have a margin of safety in returns that covers a half-life of 20 years or conceivably less, which is a fade rate of 3.5%. But if you do all that in returns, you're going to start to be making intelligent growth investing decisions, which are Graham and Dodd, Buffett, value investing decisions. And I'll leave it there. Let me stop.
Yeah, so there's so much there that I would like to unpack a couple of things also in line of what people are asking, the attendees are asking. So I'll come back to this issue of effect.
Start with gross history. So suppose they are reinvesting half of the earnings, and you think that at fair value, the earnings return ought to be about 8%.
Right.
So that means they're reinvesting 4% of their money at fair value. Does it look like earnings or any other measure of intrinsic value are growing at 4% a year? And there are lots of companies that retain a lot of earnings, and you don't see any earnings growth beyond the organic growth at all.
Right.
And that means that the return they're getting on that is close to zero. So that's where I would start. I would start by asking, is the historical growth rate seem to identify or be associated with positive returns on those retained earnings, commensurate with the amount of retained earnings? Second thing is I would look qualitative. The highest return investments in franchise businesses by far are operational improvement investments. They're investing in reducing costs. We know when we look across companies that the most efficient company in an industry, typically with the same technology, the same kind of labor force, the same capital intensity, has a cost structure a half to a third of the industry average. So there are these enormous unexploited cost savings that you're only going to take advantage of slowly over time, but you want to see a budget that's devoted to that. If the budget is devoted to expansion, you want to see that they're expanding where their competitive advantages carry over. And in China, there are no competitive advantages because it's very dense, so anybody can enter the market at slow scale, and it's changing really rapidly, so there's no customer captivity. So if they're going to China and they think they're going to create a lot of value there because, you know, it's a fast-growing market, they're just kidding themselves. So you want to look at the quality of expansion strategy. First, within their existing market, like when Walmart goes from basic Walmarts to supercenters and adds food, because there you're protected fully by the barriers to entry. Next, adjacent markets where barriers to entry carry over. Third, if you have to, go after other markets where there is no existing dominant competitor and you think you can dominate those markets, but do it one market at a time. And if they're not doing that, they're destroying value.
Very good. So let me then think slightly differently then about, let's go to this issue of the fade rate a little bit. You were mentioning, rules that we can follow. I assume they're industry specific. It's something about that particular industry that informs your estimate of the fade rate to do the appropriate correction in the return calculation so you have enough of a margin of safety. Do I understand this correctly?
Yes, exactly right. And I think also there's a way to think of that.
Right.
Which is start with 20 years from now and simply ask the question, do we think, and I'll use a specific example, do we think railroads are going to be a critical part of the transportation infrastructure 20 years from now? And if the answer to that is yes, then the half-life is certainly longer than 20 years. If you think 40 years out and you think basically by 40 years out, we're going to have smart trucks. And smart trucks are going to be organized into basically truck trains that are driven, 4 feet away from the truck in front of them and drafted with nobody in the cab because they're all run off GPS systems. Then it's not clear, especially if coal goes away, what the advantage of trains are. And basically, for roads, you've got a shared use right of way, which is extremely efficient. For trains, you don't have that. And so I think if you look at 40 years and you say, okay, I think that there's a reasonable chance 40 years from now, these are going to be dinosaurs. I think then you would say, okay, that fade rate is 72 divided by 40, which is, if I'm right, 1.8%. Whereas if you think it's going to be gone in 20 years, it's 3.6%.
Yeah, no, I actually think it's quite useful to think that way in terms of different scenarios and how you see about that. Can I bring you back 1 second, Bruce, to this issue?
The first is this a nascent company in an emerging market? And the ones that I would talk about there are, is this a self-driving car company? Or is this even a Tesla company? Well, the question with those companies is that those are emerging technologies, and emerging technology markets usually have not stabilized them. So that you don't have customer captivity because most of the customers aren't in the market yet. And you don't have customer captivity because the technology isn't that stable. And buyers are always looking around for new technology. And nobody yet really has scale compared to the full size of the market. And if you see that happening, I don't care how fast this company is growing at the moment, you're not going to be able to predict what that company is worth because you're making 2 bets. One is that when the market stabilizes, this is going to be the dominant company. And 2 is that you have an idea of what this company is going to be worth and what this industry is going to look like in the fairly distant future when the industry settles down and you have a dominant competitor. And I think, remember, there is a too tough to call pile. And I think nascent technologies all fall in the too tough to call.
So let me ask you.
Let me just,
sure.
Okay.
Go ahead.
Then you've got the case of the Googles of the world, the Microsofts of the world, where the market is stabilized. And there, I think you can certainly say, you can do a long run view. So Google, for example, is a form of information advertising. It's what you go to when you made a decision to buy, like the Yellow Pages or classified ads, and you want to find out what the price is or where you can go get this. Well, we have a long history of information advertising that typically grows about 1% faster than GDP. And you can go ahead and say, okay, in the long run, this is going to be the growth rate that I'm going to apply. And don't try and guess the interim growth rate, or I think, try and guess the ultimate market size of this company, because that's going to be very hard. So just apply that long run growth rate, and if it's a bargain at that long run growth rate, as it was for Google in 2011, then that's going to be a good investment. But inherently, you're going to be very conservative.
Yeah.
Because you're in an environment that's very, very tough to predict. And again, value investing is about knowing what you're buying.
Right. But can I ask you something, Bruce? I mean, and hey, I'm a glutton for punishment. So let me push back a little bit on this. Okay, let me see. Now, you obscure economists better than you are.
Let's talk about the history of search. So, Google goes public in 2004, but it becomes Google around 2008. Before that, who are the dominant search engines? I mean, it's Intome as a real vote, and everybody decides that's going to dominate things. And then Alta Vista comes along and wipes out Intome. And then Google comes along. I think it's very hard to tell, unless you are a real expert in that industry, that finally Google has solved the search problem. And that there are not going to be big improvements over Google. And this is once you start to see that, of course, you do see that Google is very good at protecting its dominant market share.
Right.
It's very good at improving the search experience, improving the advertising experience over time. That makes it very hard for entrants to catch up to them. But I think until that point occurs, you're going to be speculating and think how much money could have been lost in Intome or Alta Vista.
Got it. Okay, so I don't want to run out of time. Value. I'm sure you have a view because you have a view.
I do. And that's why you're laughing. I thought our timing was not so bad with this book as it was in the 2000 book.
Right.
If you look at the broad sweep of industrial history, and I'm going to talk about the United States here, but it clearly also applies to Europe and to the developed countries in Asia, there are two basic transformations that take place. The first is you go from agriculture to manufacturing, and the second, which you're in the process of doing, is you go from manufacturing to services.
This is what I've talked about a lot as well, whereas this country, 100% of the population was basically agriculture. Then we had a transition where the men went to manufacturing, and the problem with manufacturing is the technology grows at 8% annually, whereas the demand is only maybe 3 or 4%. So you got a lot of idiots that presidents that let's bring manufacturing back and blah blah blah. Like, manufacturing is always going to go down because technology, you got robots and stuff doing the job that people used to do. I mean, it's just a fact of life, as people invent new inventions and stuff. They make things easier and you don't need as many people because you got machines doing their jobs. But so manufacturing focused more on the men. But now, the U.S., probably 80% of the economy is service-based, which favors women because women are better at communication and talking to people and those kind of skills, where men are not good at that at all. And as if you had a man that was in a manufacturing job and his job got lost and cut, sometimes he has a very difficult time re-entering the workforce because there's not a lot of good alternatives where he could make a very good living doing something similar. But anyway, I'll shut up and let Bruce talk.
When you go from agriculture, which is disaggregated, where people in the small institutions, small farms, people work individually, to manufacturing plants where people work collectively in their big institutions, all of a sudden productivity growth really accelerates. Because you can put engineers to work, you've got lots of workers interacting and improving the process. And so post-World War II, when this transformation is achieved, what you see is very rapid growth in economies in Europe, but also in the United States after the war. It's unprecedented. At the same time, what you have for manufactured outputs early on is you have national markets. And the national markets are ones that national companies can dominate. So you look at the industrial companies in those days, it's the General Electric, the General Motors, the IBMs, the DuPonts, the Mercks that dominate US markets and make a ton of money. They are in fact franchise businesses. And that is a golden age for returns on capital. General Motors returns on capital at that time, from sort of after the war through the 1960s, are well above 40% a year. But over time, what's happened to those markets is they've globalized. And as they've globalized, the required minimum scale that you need to operate has gone down. And competition is intensified and entry is intensified. And the long run trend, sort of post 1960, has been one of declining profitability, of declining barriers to entry. And therefore, over that whole period, growth returns have been disappointing. That the Nifty 50 didn't just fall out of favor because they were overpriced. They fell out of favor because they were overpriced and the returns were uniformly disappointing. That trend meant that if you were a value investor who didn't buy growth, by almost that judgment, you were going to be performing relatively better than the market on average. Since roughly the late 1980s, early 1990s, when we moved to services, the opposite has happened. On the one hand, there's bad news. Service organizations, service productivity takes place in relatively small organizations. People, even in universities and hospitals, work individually. So what you see is slowing productivity growth and, by the way, a much more uneven distribution of income. But here's the thing. Service markets are local markets. They're goods that are locally produced and consumed, and those are small markets that people like Walmart could dominate. And that meant that over time, barriers to entry were increasing, monopoly profits were increasing, and the value of growth was increasing. And then in technology, a trend was taking place that actually intensifies those problems. So what happens with technology is you go from a case like IBM, where IBM does everything, that you don't do piece parts that the consumers of the technology put together, to a post-PC era where value chains are disaggregated and everybody has a small piece of the technology. Google dominates search. Microsoft dominates only operating systems and then operates at the edge of that. Adobe does fonts and video processing. Oracle does only databases and sort of related applications. Salesforce does only Salesforce management. And as that happens, technology has balkanized those markets. And remember, small markets are your friend. They dominate those markets. And the trend is that they make above average returns, and because there are barriers to entry, growth is more valuable. So I think what you've seen, and you can see it, by the way, in the US profit pool. In the late 1980s, early 1990s, profits were about 8 to 8.5% of national income. Today, it's between 13 and 14%. And that's all this sort of these moats, these markets that can be dominatable coming into focus. And that means growth has been more valuable. And if you're not on the growth train, buying growth intelligently, you're really going to suffer. And I think that's why I say for this book, I hope we've done something that actually gets the timing right to help value investors adapt to an environment where they're going to have to start thinking about paying for growth.
Yeah, exactly. So, but Luis Sillas, who's an attendee, is asking almost as his own cue whether the FANGs are the new Nifty 50. But clearly your answer to that is no, precisely because they're specialized in the services.
Yes, absolutely. And when they try and go outside their specialization, just look at the non-Google part of Alphabet. It's not worth squat. They don't make any money. So as long as they're disciplined and they stick to those market segments, they're going to continue to benefit. Also, manufacturing companies like Deere that have very well articulated local service and software support operations, so they dominate local markets, are going to also do very well. So I think this is a different world. I don't think this is 2000.
Bruce, I mean, one of the questions that is coming quite often in the Q&A tab, and that I would like to spend some time.
Markets, forget it. It's going to be asset value, earnings power value, because they're not going to dominate those markets. If these are banks like M&T that started out dominating Buffalo, and
this question is whether you feel the method is applicable across all industries, whether energy, tech, you see, whether particular industries. So someone asked the question about, can we apply this framework to banks on account of how highly levered they are, for instance?
Okay, the answer is, it depends whether they're franchises or not. If these are big global banks competing in global markets, forget it. It's going to be asset value, earnings power value, because they're not going to dominate those markets. If these are banks like M&T that started out dominating Buffalo, and Buffalo is an unattractive enough part of the world, so if you're willing to hold your nose, you can dominate it, and then expand it adjacently going down I-87, those companies you're going to have to evaluate in terms of returns. But let me say this. Inherently, these return calculations, I hope it's clear, are much more complicated than the asset value calculations, because you're looking into the future of the world. That means that you're going to have a higher degree of industry expertise than you have in the past. And I think that means in turn that value investors are going to have to become specialized. And I think they're going to have to become specialized by industry, and I think they're going to have to become specialized by country, because that's where the service operations occur. So I think the answer is yes, there are banks that look like this, but you better be a banking expert if you're going to do a good job of applying this framework to get what these banks are worth. Now, let me say one last thing about this. You'll notice that this helps you at the entry point. You have a price that's given to you by the market, you can calculate a return. It's not going to pick the exit point for you.
Right.
When you pick an exit point, you basically got to pick a price, and these returns are not particularly sensitive to the prices over fairly wide ranges. So, and I think this is the experience of good growth investors, that the buy decision is one that's manageable. The sell decision is brutally hard. And typically, people like Warren Buffett just have arbitrary rules. He never sells. Seth Klarman would never pay more than 20 times earnings. I think he's up to 25 times earnings.
Right.
But, there's going to have to be an arbitrary choice. So I think there are industries where it's hard to apply, and you've got to be an industry expert. But yes, I think this applies to all franchise businesses. And if it doesn't, ask yourself this: how are you going to value those businesses?
Right. So, an attendee, Adriano Duriguel, asked a very interesting question, which is,
so when you do a sensitivity analysis, it's not doing a complicated series of Excel runs with different values. You have if the cost of capital is 1% higher, your margin of safety is 1% lower. If the organic growth rate is 1% higher, your margin of safety is 1% higher. The earnings, the current earnings return and sort of the reinvestment return, you can calculate based on history, but you know the effect of a value creation factor of 1/2 versus 1. It adds linearly to this return. The advantage of that is that if you're a good value investor, you want to start with a conservative estimate where you're pretty sure that this is going to be what organic growth is going to be. And the most conservative estimate for these things, unless it's a dying franchise, which is brutal, is going to be just GDP growth for the growth. But you start with that conservative estimate, and then you can tell immediately what the impact is going to be of things being better or worse than you thought. Because it is linear in the organic growth rate, the cost of capital, and it's linear in the fade rate. So I think that's the other thing that's crucial about this. And again, it really is part of the Graham and Dodd genius. What they do is they develop a very simple, transparent framework for incorporating the information about the world that you collect. So much more, asset value, earnings power value is a much more transparent framework than a DCF framework. So when you do the sensitivity analyses in your head, you can do them that way. You're not giving free rein in the context of a complicated calculation to your hopes and dreams.
Yes, I'll go back to the point of the DCF because in a moment, but because I know how do we explain that success in a particular business? I think AWS is a different thing, but it's a surprise, so to speak.
Oh no, I love it. It is very rare, and again, let's go back to Google, which is a bunch of really smart people.
Right.
Companies do well in multiple businesses. If you go back to Microsoft, Xbox, which is a different business, they just don't make money. They finally profitable margin, but it was a very bad investment. It is very rare in this context when we're passed away from General Electric, we're away from General Motors and these great big industrial companies, that companies are good at many, many things. So I think that when you see Amazon be good at multiple things, you have to say, okay, that's lucky. I mean, General Electric was an exception at doing many, many different things until it wasn't. And I think Amazon has been an exception on this. It's done exceptionally well in web services, and it's done sort of well in retail. But I think there is some good news about Amazon. My guess is, and again, think 40 years from now, the trend in technology is that it's interchangeable. If 40 years from now, or even 20 years from now, the web, God, what's it called? Cloud computing is not a commodity product, I will be amazed. And people will come in and they'll just switch you at no cost, and it's going to be a competitive, because it's a huge market. And
there are already technology solutions to facilitate that.
And I don't think anybody's going to dominate. On the other hand, if you look at Amazon's retail business, there are two parts to it. One is there's the web retail front, which is transaction processing. And two is there's the distribution network behind it. Net retail fronts are a dime a dozen. Nobody's going to dominate that. It's too easy to use Google to find things. On the other hand, distribution is a series of local monopolies. And Amazon has gotten much smarter about that. So if you look at Amazon globally, they were going to do everything. And now they've decided to concentrate on India. If you look at the way they're building out the distribution network in the United States, they are sequentially trying to dominate localities before people with dominant local distribution networks like Walmart get into the business. So at least in that dimension, they seem to have gotten some.
Thanks. Bruce? That we're experiencing.
Okay, I think actually the fixed income returns are crazy. And I think that from 0 to negative, expecting them to go down lower so that you make capital gains on your fixed income securities is just not going to happen for you.
Not going to happen. Yeah.
So I think the fixed income returns that people are going to get, which are going to be sub 1% on safe assets, are going to be wholly inadequate compared to historical experience. On the other hand, the striking part of history is if you had invested, in 2008, right before the crisis, sort of the middle of 2008, from 2008 to today, you would have made a 6 to 7% return, which is very close in a low inflation environment to what equity returns are.
Right.
And those are pretty good returns. And I think that the weird thing is, and it's been sustained now for at least 7 to 8 years, is while these fixed income returns are crazy low, the equity returns have not been crazy high. I mean, the FANGs, they've been crazy high in some sense, but again, that's because people are willing to pay for growth rates that are very hard to judge. And I think that sensible value investors are going to stay away from that. But still, there are extraordinary opportunities for companies, and again, I don't want to sound like a broken record, but companies that understand local market domination in services. And Deere is a classic example. I mean, there was this huge disagreement between me and Jim Grant when Deere was at 75, and he thought it was going to 25 because in traditional terms, demand was going to fall, and it had. And they were going to be loss-making for an indeterminate number of years. Well, life had changed. They were no longer a competitive equipment maker. They were a monopoly service provider. And I don't know where the stock price is today, but I think it's well over 200. I think it's like 225. So I think there are extraordinary opportunities here. And an overall level of equity markets that is not all that crazy. I mean, there are obviously areas of valuation that are out of hand, but that's what value investors typically avoid.
All right. Very good. And so I completely agree, but can I ask you something a little bit about this? I mean, so I want to explore one thing a little bit more deeply.
I have to say that I don't know about most prices, but in terms of equity prices, the multiples of current earnings, and I think current earnings look not only sustainable, but for many of these unrecognized franchise businesses that are well run, there is a growth element to the return that doesn't get figured directly into the PE. I don't think that the equity prices have responded. I mean, they just have not gone up that much. And remember, profits look, let's just say that profits from 1990 to 20 have gone up by 60%. That's about the profit share of GDP. So it's 60% above the growth rate of GDP, whereas historically it had been at or below the growth rate of GDP. Well, 60% over 20 years is like 2.5% a year. So that's an additional 2.5% return that's being driven by these economic forces that we've talked about. And if you add that 2.5% return to current earnings, what you're starting to see is multiples that are not that crazy. So I think that in stock markets, you haven't seen this. I don't know, what's happened in real asset markets, although certainly oil wells are not trading that expensively, and I don't think timber is trading. Commodity prices certainly haven't gone through the roof. So I think fixed income is crazy. I think it's insane. I thought it's been insane for a long time. But, there are these other pockets where you can actually look at, based on a reasonable judgment about the continuities of history, what kind of returns are in the market. And the equity prices don't look crazy.
So, there's a lot of questions about whether you would be willing to talk about things that you like in the market specifically, that you've looked at recently that you like. I know that you're always reluctant to share your views on this, but I will be a faithful host and convey the questions from the public on this call.
Well, all right, so let me talk about an opportunity that exists in the market in one company actually in Sweden, but really is a much greater opportunity. And you want to think about companies that take advantage of opportunities like this. When you look at electrical or plumbing contractors, who do jobs for big construction projects. That's an incredibly balkanized market. There are a lot of little companies in any city, and if you look across cities in a country, there are literally hundreds of companies like this with 40 to 60 employees. There is a company in Sweden called Instalco that I think started off in Gothenburg with a 30 million euro investment and decided that as these old guys who ran these smaller contractors retired, A, they could buy them out at a relatively cheap price, 4 to 5 times earnings, and B, by putting them together, there would be economies of scale in force deployment, in bidding for opportunities, in purchasing, and in other just overhead functions. And Instalco, as I say, which started out as a $30 million euro investment, I think, it's been up and down lately, but the market price, which we bought into at I think about 45, is over 200. It's something that's done really well. And you can see how opportunities in small, balkanized local markets like that would exist if you're intelligent the way Instalco was, where they did Gothenburg first, then the rest of Sweden, then very carefully Norway and parts of Finland, where they thought they could dominate. And you can see countries like Switzerland and Austria in Europe, where probably somebody could do the same thing because they're isolated, smaller local markets. Conceivably, in the United Kingdom, it might be the same, or parts of France. But there'll be opportunities like that locally in the United States. So I think that those are looking at industries with opportunities like that and looking for companies that have the ability to take advantage of that because they understand structuring local economies of scale and a disciplined expansion strategy is where you're going to make money.
So I want to finish a little bit. I have several questions about the future of value investing, Bruce, and a little bit how we think about value investing going forward. I think the second edition of the book, to end where we started, answers the question of growth, which is the way forward. And I want to ask you two things about this. One is, value investors do the hard work of actually reading the annual report, thinking through economics qualitatively, and so on and so forth. Technology has, made a difference in many industries, in many types of jobs. Do you see the job of a value investor being substituted at some point by a piece of software, artificial intelligence, that can do what we do? You think that, we have several students asking, young Ryan O'Neill from Ireland, who is asking about this, whether he should consider learning value investing, given that he's worried about the future of technology, taking away his dream job as a value investor in one of the big value investing shops. So what are your thoughts of that?
Okay, I think that in a sense, this necessary movement to doing valuations of growth is a godsend on that dimension. Because judging future growth is something that's very complicated and very specialized to do. It's like historically looking at reproduction values of assets to validate earnings power was something that took a lot of detailed industry knowledge. It changed relatively rapidly as industry technologies changed. So I think the first thing that's going to happen is that value investors are going to have to be specialized, because they're not going to be able to do these complicated tasks well if they're not specialized, not only, by the way, probably by industry, but also in many cases by geography. I think because that's where you're going to get to know managements. And again, when you talk about the future, managements have a much bigger impact than just sort of the asset-driven histories that value investors have dealt with in the past. I think it's going to be very hard to do general models of that sort. I don't think you can. So then the question is, are people going to do it industry by industry? And we haven't seen that in the artificial intelligence business, not even close. I mean, the models are all cross-industry, cross-market models, would be necessarily, therefore, simple, unambiguous measures of value. So I think the answer is no, but you're going to have to be a specialist in 1, 2, or 3, maybe 4 industries at most, which is what Buffett seems to be able to handle. So that, I think, is the answer to that question. And if you're disciplined about doing that, you're not going to be replaced by a machine within the next 30 years. Having said that, though,
right,
there is a problem out there that I don't think we solved in the second edition, and we've talked about this, Tana. We count on you to solve.
Yes.
Specialist analysts still have to contribute to people who are going to build diversified portfolios. How you manage risk in this environment is a brutally difficult problem.
Absolutely.
And I don't think anybody has a good answer to that for the moment. I think value investors have a better definition of risk. But how you position size properly, how you combine things across, different countries, different asset classes. I think there aren't going to be models that do it, and I think Tano is going to train, what's his name, Riley in Ireland, to do that really well, and it's going to involve a serious intellectual effort on his part for the next 20 years.
Yes, I think this is exactly right, that the definition of risk for value investors of permanent loss of capital requires a different way of thinking about risk management relative to how traditional business schools teach this, and that remains an open question. So let me just finish with one question that people are asking, which is, when is the third edition coming out, Bruce?
Never. Now, let me say why. For this business, Judd and I have written 2 books. One, which is Competition Demystified, was actually a good book, and we're never going to have to produce a second edition. The first value investing book is actually not a good book. I mean, there's this huge area that, if you look at the examples we give, so the way we tried to value Intel and WD-40, it was incredibly feeble. If you look at the second edition, we've really actually done a good job. And since we've done a good job on the second edition, and Tano is going to be responsible for the risk management and position sizing problem, there is never going to be a third edition.
But we'll hear much more.
Anyway, thanks for watching, guys. Again, this was from Columbia Business School, talk with Bruce Greenwald on his second book called Value Investing from Graham to Buffett and Beyond.